welcome to Trading Hour on CNBC TV 18. I'm Ekta Batra. With me is Prashant Nair, and it's turning out to be a session where we're just about consolidating for the Nifty, and there's a little bit of pressure which is coming in for the mid-cap index as well as for the bank Nifty. So respectively, both those indices are down anywhere between 0.2 to 0.3%. So overall, yes, consolidating for the frontline indices, a bit of an underperformance for the mid-caps. Week to date, MSCI India is flat. MSCI Asia ex-Japan is higher by around 3.9%. So there's been a relative underperformance coming in for the Indian markets. And maybe one of the reasons would be Brent crude prices, which have risen around 7% on a week-to-date basis. A lot of stocks in focus. TCS Infosys dominating on account of numbers. TCS reacting to numbers. Infosys coming out with numbers. ITC as well, where there is a positive brokerage note, and conversely, Bharti Airtel reacting negatively to an analyst note, and Everready, which is spiking up around 14% on speculations of M&A there.
Absolutely. I mean, there's lots of things moving around, but the market at the index level is absolutely flat. Which is not a bad thing at all, given the fact that the market's done so much. I think to me what also stands out is the fact that the US market continues to charge ahead after a very smart bounce in the preceding 2 weeks. I mean, unless something dramatic happens later today in the US last session of the week, I mean, the US market is I guess started this year on a pretty good note, especially given the way things were. The sentiment was soured and there was real talk of a slowdown, etc., etc. But it's not really affected US markets, and that's a positive thing. I think we should keep our fingers crossed because once that starts to sour, sentiment here starts to become shaky pretty quickly, as we found out late last year. So that said, in terms of fresh cues, there isn't very much. You had a slew of Fed speakers, and I think some more are speaking today, but the message across the board from the 10-12 speakers we've heard so far this week has been pretty clear that rate hikes, etc., are not on autopilot. Nothing is given. I mean, and that's a good thing, because what was being taken as a given was that we will see 2 rate hikes. I mean, people are talking about cuts now. So we've come a far way in the last 3 weeks. Okay, we'll come back to macros, top-down issues. We've got a special guest also joining us a little later on the show. But let's start with trades, as always, right on the top of the show. Kiran Jadhav is with us today, and he's going to run us through what you should be doing in terms of trades. Kiran, morning. What are your trades?
Prashant, very good morning. See, basically, if you look at the Bank Nifty is showing a negative divergence, and it is trading at just below its crucial supports. 27,500 is a crucial support, and trading below it gives a negative outlook to the Bank Nifty. So my first short call would be IndusInd Bank, which should you should sell IndusInd Bank. It is negotiating its important supports of 1550. Once it breaks down, I believe the intensity of the sell will increase. My stop loss would be 1565. My first target would be 1540. Second target for today would be 1533. This is my first trade. The second trade is Sun Pharma, which is a long. Sun Pharma for a good time now has been clocking higher tops, higher bottoms, which is a sigh of relief for this counter. And with the kind of momentum that we have seen from yesterday's second half, I believe that this should continue for the day. Here I have a buy. Stop loss is 445. Target is 456. And the next call is ICICI Pru, where for the last 2 days it has been showing tremendous momentum, and I believe that this momentum should continue for some time more, a day or two. Stop loss, if we buy a position right now, would be 352. Target would be 363.
Okay, all right, Kiran. So there are 3 calls coming in from you. IndusInd sell, buy on Sun Pharma, and a buy on ICICI Pru. We have a Twitter query for you now. Rahul has 400 shares of Canoria Chemicals at 71 rupees. He wants to know whether to hold or sell.
Canoria is a hold for now. It has done a good base building formation at around the 60 levels, and yesterday it moved up with huge volumes. Today it is correcting a bit with the markets, but I believe that this momentum will stay. It is a stock which moves up one day and then consolidates for a good time and then continues its up move. My stop loss for now would be 70, And say in a fortnight, we should be heading towards the 84 kind of mark.
Kiran, it's a pleasure. Thanks very much for joining us and running us through those trading ideas and some advice as well. We get to the stocks that we are talking about today on the top of the show. Tata Motors is the first one. It's actually in the red despite JLR December retail sales coming in better than what was expected. Sonia is here with the details. Sonia.
Well, thanks a lot for that. Actually, the numbers are better than street expectations, but it's still a fall of 6% that we've seen in the JLR retail sales in the month of December. Now, if you look at the breakup, for Jaguar Land Rover, it's the Land Rover sales which have been declining, and that continues to be a big concern. And across geographies, China is still the big worry spot for JLR. So even in the month of December, China has fallen sharply down 42%. But the positive is that all the other geographies have seen an improvement. So whether you look at North America, it's up 21%, UK is up 8%, and Europe is up almost about 8% on a year-on-year basis. In addition to all of that, yesterday there was news that JLR will be cutting 4,500 jobs as part of their £2.5 billion cost-cutting program. So that as well will be operationally positive for Jaguar Land Rover. Now, Nomura has said that the stock currently, of course, it has risen about 8% in this month, but after the recent fall that we've seen in the stock, it's trading at the lower end of its historic trading band, which is it's trading at about 3.5 times FY20 EV to EBITDA. So valuations are attractive, and not just that, there are some positive triggers going ahead for Tata Motors. One is the positive free cash flow generation they're expecting in the second half of the year, and second is the success of the new models, which could lead to an improvement in volumes in Q4 of FY19. So there are optimistic views coming in, but China, which is a big market for them, continues to be under pressure, and that perhaps is the reason you're seeing a bit of a slowdown in the stock and some profit taking as well after the 8% run up this month.
Okay, yes, absolutely, Sonia. It's been a tough year, and more than that for Tata Motors in terms of job cuts, as well as the 3-day production week, as well as China. But Everready is the other stock that you're watching. There are reports of the promoters, in fact, looking to sell their 44.3% stake in the company. What have you picked up?
Yes, in fact, this is a Times of India report where the promoters perhaps are looking to sell their stake, their little over 44% stake. Now, the battery business has been in the doldrums for a while, and the promoters are looking to restructure the business in order to pare down their debt. This is something that Amritanshu Khaitan has been speaking about as well, their debt reduction plans. They could do this by inducting a strategic partner as well, giving up a bit of their stake. That could be, a step one of the process. We did try and reach out to Amritanshu Khaitan. He said he doesn't want to comment on it. So, it's just speculation at the moment. But the stock is running up in the hopes that the promoter will not sell the stake. He will look to sell at a premium. So, on that hopes, the stock has run up. However, the stock has eroded a lot of wealth for investors. It's halved over the last 12 months or so. But as I said, we did reach out to Amritanshu Khaitan. There was no comment from his end.
Sonia, thank you very much for running us through those two stocks. Tata Motors and Everready going up on big volumes. TCS, though, is the top loser on the Nifty today following the third quarter earnings. There was a margin disappointment. Rima is here with the highlights. Rima.
Well, the margin miss was largely an account of an increase in the subcontracting costs as well as local hires due to the talent crunch in the US, and the company had to make those subcontracting hires and local hires to meet the kind of demand. So because of this increase in the on-site costs, the EBIT margins declined by 90 basis points on a quarter-on-quarter basis, much lower than street expectations, and this has resulted in brokerages reducing their margin estimates not only for FY19 but all the way till FY21. So CLSA reiterates their buy rating on the stock, but they've cut the target price to 24.60, while Kotak has a reduced rating on the stock on account of stretch valuations, and they too have lowered the target price to 18.25. Now, earlier today, we got chatting with the management, and here are some of the key takeaways. So first, on the margin front, they did acknowledge that yes, there is a skill shortage in the US, and the company is taking steps to address it, but that will take some time for it, till it actually materializes. But per se, there is no structural challenge in the company achieving its margin guidance band of of 26 to 28%. Now, on the subject of growth, the company sounded very optimistic. Now, a double-digit growth in FY19 is already in the bag, given the run rate they've enjoyed in the first 3 quarters. But there are people who are skeptical about FY20 considering the macroeconomic risk. So on that, the management said that there is no reason why the company will not achieve a double-digit growth in FY20. But of course, it's too soon right now to talk about any macro shocks because it's been spoken about for the last 2 or 3 weeks. Also, this time around, the company is enjoying a broad-based and accelerating order book versus in the past, which was concentrated only in a few sectors. Again, they said it was too early to talk about macro concerns. There is some softness in UK BFSI. They've seen cautious spending in UK and continental Europe because clients are waiting to see which way Brexit shapes up. Right now, the priority for the company is to actually invest in growth, capture the demand, and not so much about defending a particular level. They all, just another example the company gave to indicate the kind of demand. They said that we wanted to create a local bench, but they couldn't. In fact, demand was so strong, they had to go ahead and hire subcontractors to meet the kind of demand. So very optimistic right now on demand, barring any unforeseen or macroeconomic shocks, which is too early to talk about. With respect to increased costs, yes, it may go up in the medium term, but in the long term, the company is confident about holding on to its margin band.
Okay, all right, Reema, thanks very much for that. So margins are disappointment, but the demand outlook as of now in terms of commentary is quite steady.